This has been a highly controversial position, and it is really misunderstood. The shares today are selling for around $13 a share, and as I will explain, they are clearly worth about 27. And they can appreciate to that level quite quickly. Further, I will show you that by selling puts over a 2-year period to enter our position, we now have over 0.5% of this entire business. We own 0.5% of Seritage. And after all of the premiums we've received, our net cost has been whittled away to just $6.57 a share. Seritage Growth Properties owns and leases and is now liquidating 150 remaining ex-Sears mall anchor and standalone stores that were spun off prior to the Sears bankruptcy. Some of these properties are not worth much. We know that. Others are in ideal locations like Santa Monica, California, Redmond, Washington, Dallas, Texas. The only reason that we've been able to hold on to this stock so confidently is because we did the work to understand the value of each property. Years ago, we began an extensive valuation analysis of every single one of their original 212 properties across America. We visited many malls in person. We visited every mall on Google Maps. We called mall management offices on site. We talked to local brokers. We used CBRE data and online tools to understand the value for every square foot of these properties. And last November, I met with the ex-CFO, Amanda Lombard, who is able to confirm our overly conservative estimate of some of these major properties. So how long does this type of deep analysis take? It isn't easy. Each property is unique. And with everything involved and all of the moving parts, I would estimate it's about 1,000 hours. So we can be confident in our conviction because we have the information that nobody else has. And we monetize this information by buying stock through the sale of puts during dips rather than panicking and selling like many others. So I will show you an example of one of their 5 premier properties outside Fort Lauderdale called Aventura to give you a sense of how we do our analysis. So Seritage has redeveloped this Sears footprint into 215,000 square feet, of which 75% is in contract for long-term leases. Now at the bottom, we've calculated average rent revenues of $100 per square foot and net operating income of $65 per square foot. So CBRE publishes regional local cap rates on different property types, and they've observed a Fort Lauderdale suburb retail business is selling for a cap rate of 5 to 5.75. So we're using an even more conservative cap rate of 6 in our calculation on this property. And in blue, I've even done the math for you. They earn $65 in operating income on each of the 160,000 square feet that's currently in lease contracts. And if we divide that by 0.06 to account for the cap rate, we can expect this property to be sold for around $170 million and maybe more. And this is conservative. So Seritage has changed directions, and it's in the process of liquidating everything to maximize shareholder value. And they have stated publicly their expectations to make distributions of between $18.50 and $29 to every shareholder over the next 24 to 36 months. And our modestly sized fund has managed to accumulate 0.5% of this whole company. It required about 10% of our capital this year, and the position has already grown to over 20% of our portfolio. So let me show you the NAV estimates for each of our 5 property types. They categorize properties as premier mixed use, residential, multi-tenant retail, et cetera. And through our property by property analysis, we understand them to be conservatively worth about $2.9 billion, including cash. So after they cover their debt, which is actually to Berkshire, of $1.4 billion, the stockholders are left with $1.5 billion to divide up and distribute to the 56 million shares. By our calculation, $27 per share is reasonable, and management has provided these estimates of $18.50 to $29 per share, and they have no incentive to exaggerate those numbers because they want a reputation of being successful. So they are presenting figures that they expect to exceed. Today, this stock is available for 13. So without using structured value, I fully expect a shareholder to pay out twice as much over the next 8 to 12 quarters. It's really remarkable. But of course, that's not how we operate in the market. And that's more than we paid for our shares. We sold puts and obtained millions in premiums to buy the stock from others before we bought the stock really from others. And by the way, it's worth noting, Warren Buffett bought a personal position in this stock and paid $35 per share, 5% of the company. Through selling puts and indirectly purchasing our shares, they cost us just $6.57. And furthermore, we didn't actually put any of our cash out until just this year. So we've already made 100% on Seritage. We expect them to deliver 200% of today's stock price in cash to us over the next 8 to 12 quarters as they liquidate this business. So this is now a 20% holding in our portfolio. So when it doubles, the whole firm is going to earn 20% from a single position. And we're likely to receive basically 3 to 4 times our initial investment in cash. The funds went out in 2022, and the cash is going to come back in 2024, 2025. So we will continue to monitor the developments here very closely. As they wind this down, it is a very interesting time because we get to compare our estimates with what they are selling for. And we are finding ourselves to be quite